Afternoon. This is Jim Barlow with OakTree Strategic Leverage. Our topic today, executive and employee benefits. But I'm doing a little different version. Is there a better way? I'll show you a transformative approach to executive employee benefits using my new inversion wealth framework and Kaizen. So let's get started. I've told about me. Here's a little bit. Here's just a review. Lifetime resident of Clearfield, Utah. Married to Barbara. 7 children. 28 grandchildren. I have a great grandson being born about the end of June. We're getting excited. I'm a BYU graduate. Devoted fans. As an investment advisor for 35 years. And our passions and values. Well, family's everything. We love to travel and we be together. We serve in the temple. I believe in doing good and helping others. That's the reason for my OakTree Strategic Leverage Company today. Saturday, we're leaving for Orlando for a couple of weeks. I'll do some webinars from Orlando. We do a reunion every 2 years. This is a picture of our reunion of actually 2 years ago. We've got a reunion coming early July, and we'll be in Bear Lake, and we'll do a new picture, and I'll put it up there. So most people are looking above the surface. They'll see the iceberg. They don't see what's underneath. They focus on returns, growth, upside. But what actually causes failure lives below: hidden risks, timing pressures, forced decisions. Inversion thinking starts where others don't look. We're looking underneath the water. We're looking at this iceberg. We're making sure we absolutely cannot run into a problem. So what is inversion thinking? It's a way of solving problems backwards. Instead of asking, how do I succeed, and looking for all those upsides, you ask, what could cause this plan to fail? Then you eliminate those risks. That is inversion thinking. Most people ask, how do we just succeed? Inversion says, what would cause us to fail? In business retention, avoiding loss matters more than chasing upside. Why executives leave? They don't leave for 3% more salary, do they? One-time bonuses, extra PTO? I don't think so. They leave because long-term wealth feels uncertain. Their financial future feels exposed. They don't feel structurally protected. Their wealth plan depends on markets. They're a little bit unsure about this future. They think they can improve these things if they move. Each retention failure is a structural failure. You need to get the structure right, and they won't leave. So, what are the retention tools we use today? There's really 4 buckets: cash, retirement plans, equity, or insurance-based plans. Let me go over all those. Cash, very common, least sticky, bonuses, raises, spot incentives, instant reward, instant exit. It's where you start, it's where you should, because it's familiar, but weak as retention anchor. You got to have a good income cash program. Retirement plans, standard benefit, 401k match, profit sharing, broad-based, not majorly targeted, long-term savings, not loyalty designed. They can move on and roll their 401k to the new employer, to their 401k. It's kind of expected benefits. A little bit like health insurance. You don't have health insurance? Oh no, I'll go elsewhere. Expected benefits, not retention tools. Equity. Stronger, but risky. Stock options, restricted stock, phantom stock, ownership alignment. Vesting creates retention pressure. Value tied to company performance. Equity can create stickiness. We want stickiness, but introduces volatility, dilution, loss of control. Maybe that's not what you want. Then there's insurance-based plans. Some structure that you've built. Executive bonus, Section 162, a SERP, non-qualified deferred compensation, the split dollar plan where you're sharing the arrangement, or a premium finance, leverage insurance structure. These are intentional retention structures. Ranked by real retention power. Structured, long-term tax-efficient wealth. Equity, I think it's a second place. 3, supplemental retirement, cash bonuses, lifestyle perks. Why most retention plans fail? Most plans fail because short-termed, not fully taxable, depends entirely on markets, lack of vesting psychology, doesn't meaningfully increase net worth, are replaceable elsewhere. Don't remove the downside. There's something they don't like. That's why they leave. Aversion applied to benefits. Instead of asking how do we reward performance, what would cause our key person to feel financially exposed? Example, market crashes, taxes, longevity risk, business concentration risk, golden handcuffs that aren't strong enough. So the unspoken fear, what would the unspoken fear be? Executives rarely say this out loud. If I stay here 15 years, will my wealth truly be protected? Or am I one downturn away from resetting my retirement clock, working longer? They want to know if staying will help them achieve their financial goals, then their retirement, their family. What truly sticky retention requires? I like that word sticky. Retention must remove downside exposure, provide long-term accumulation, some way to accumulate more, use tax-efficient structure, create vesting alignment, build non-market dependent wealth, feel transformative. So the question becomes, what would an executive employee benefit strategy look like? It was aligned from ground up to attract and retain top talent, align incentives with long-term outcomes, reduce tax inefficiencies, create meaningful, lasting value for both the business and the employee. That's what led me to build a different framework. I call it the inversion wealth framework. So we start with inversion on the bottom. Figure out what we need to do to avoid ruin. We're not going to start at the top. Then we build a structure, design a structure that fits that inversion, avoiding risk. And if we do those first two things, then we're going to multiply. We're going to do some leverage and let this thing really grow. Let me go over the 4 points. Inversion. Avoid ruin first. We've been talking about it. Identify what destroys wealth. Eliminate irreversible decision. Expose hidden vulnerabilities. Get rid of these things. Win by not losing. Number 2, structure. Build something that can't break. Protect against forced liquidation. Maintain control in all environments. Ensure liquidity when it matters most. If it can't break you, it doesn't belong. If it can break you, I'm sorry, it doesn't belong. Make sure it works. Then use capital more efficiently. Not reckless leverage, but structured leverage. Define entry, controlled exposure, planned exit. I could tell you some stories from real estate in 2008, but we won't. The reckless leverage. More capital working without more risk. Wow. Then patience. Let time do the heavy lifting. Compounding requires stability. Stability requires structure. Time rewards what survives. Everyone kind of understands a lot of these points I've made. Inversion, see the risk, find them out. Leverage, increase potential. Patience, let it compound. You understand these things. But most of us fail at one place. That's the structure. The structure is the bottleneck where execution breaks, where risk is left exposed, where plans rely on behavior instead of design. This is where most people get stuck. Not because they don't understand, but because they never built what makes it work. Structure is the hinge point, where thinking becomes real, where risk is removed, not managed, where outcome begins to shift. Inversion, see the risk. Structure, solve the risk. Leverage, amplify safely. Patience, let it compound. This is the moment everything changes. When structure doesn't just describe the plan, it defines the outcome. The right structure becomes the fulcrum. Small inputs create large outcomes. Leverage becomes safe and predictable. Time begins working for you. Structure's the edge, not just where things change, it's where power is created. Most people try to win with better returns. The few who win consistently build a structure that can't break, and then let leverage and time do the work. If we know what destroys wealth, and we know what a strong structure requires, is there already a system designed to solve for all this? Protect against loss, provide liquidity, use leverage safely, create tax-efficient outcomes. Or are we left trying to build it ourselves? Probably most of you have been trying to figure it out, build it yourself. Well, you don't have to. Kaizen is a transformative structure built on cash value life insurance, indexed universal life that eliminates downside risk, uses institutional leverage, creates tax efficient income, and defines a clear exit strategy. How it works. In a quick one slide, you contribute for 5 years. The bank contributes additional capital alongside you. Then they continue funding for the next 5 years. The policy grows with built-in protection, and then the loan is repaid around year 15. From that point forward, the structure is fully yours, unencumbered, income ready. How it fits this framework. This is what a transformational structure looks like in practice. Inversion, downside protection, zero floor, no downside. Structure defined system, not market guessing. Leverage, about 3 to 1, institutional capital. Then the patience, the long-term compounding. Kaizen, we're talking about the far left bottom, executive employee retention today, we have done. But there's other uses for Kaizen: retirement income, family gifting, family protection, creditor protection, tax efficient income, charitable gifting, key man, business succession. Executive employee is one of the keys. It's a good one, important one. Who's this for? Well, it really isn't for everyone. It's best for a high income earner, business owners, professionals, families thinking generationally. There are some qualifications. Who is the strategy designed for? Age 18 to 65. You can't buy it after 65. Health typically requires standard or better. Yes, you have to be insurable for sure, and you really have to be insurable at a pretty high level. I'm sorry, that's the insurance companies are controlling that. Income, I put approximately 100,000 or more, probably actually 200,000. Plan funding, 20 to 40,000 or more per year, and a commitment, long term. Remember, we're going to pay back the loan at 15 years. So these things change a little bit depending on the carrier and your circumstances, the qualifications. So I'm going to show you, not going to take hours, but I really think Kaizen has 4 different levels that you need to understand. I'm going to briefly talk about all the features in the next few slides. First is the foundation. You have a death benefit. It's built on a life insurance policy. We all should have death benefit if we have children and a family and people we leave behind, but we don't always do it. So we have the death benefit. Then we have the living benefits. I have a slide about that. Well, let's just go ahead to it now. Living benefits, protection when life doesn't go as planned. You can tap into part of your death benefit if you have a chronic illness. Access if you have a long-term care need. You can tap into the death benefit before you die if it's terminal. You can tap into the death benefit if you have a critical illness or a critical injury, or if you have cognitive impairment. I call these all living benefits. Benefits that are subject to policy terms and carrier availability, but wow, these are some cool benefits. So let's go back. So we have the death benefit, we have the living benefit, and we have tax-free growth and excess. Let me explain. money in the policy is not being taxed as it grows. When the owner of the policy dies, it goes to the beneficiaries tax-free. Absolutely. That's been in the tax law from the very first day. Well, we had an income tax, I think, in 1918. But we can borrow from the policy tax-free. So I can give people a tax-free retirement by using this approach. Tax-free, build efficiencies, no ongoing advisory fees, no management fees. Other than the life insurance expenses, there's very, very little fees. I think this is the foundation. Death benefit, living benefits, tax-free, and lower fees. Then we have the growth part, the risk managed growth. Market linked growth. You're not directly in the market, but you participate in market gains, and tied to that is the zero downside floor. There's no negative years. Can't happen. Lost years are eliminated. That's inversion. And then we have a negative year and everyone else is just trying to recover. You start from a higher floor. Continual compounding. No recovery years required. Let me show you how that works a little bit. Most of the premium of an index universal life policy goes into the general account of the insurance company, into high-grade bonds, with a small portion used for index options, the growth part. So, for example, if you have an extra $1,000 that's going into the cash value, 950 will be placed into these high-grade bonds, and in 1 year it'll grow back to 1,000. That's why we can say no downside. Then the $50 is put into options linked to an index you choose. If the market's at negative year, those options expire worthless, but your 950 grew to 1,000. Very simple way you can't lose. Protection first, growth second. Now a little bit of, okay. Let me show you a little bit about these indexes. Generally speaking, most insurance companies have two different types of participating in the market. One is a direct S&P 500 index that they buy options in, and you're going to get you with zero downside, but it's capped. Currently, with National Life, it's 11% cap. The market does 12, you get 11. Market does 9, you get 9. Here's the averages for the last 5, 10, and 15 years. Another approach they have to these indexes is funds that don't have a cap, because they're more conservative, than they have a participation rate. And one called within National US Pacesetter Index is giving today 260% participation. So its return for 5, 10, and 15 years is 9, 11, 14. No cap. Your choice. It's not bad to even split. Go half with one, half with another. And I did this with National. They have other options, but I just want to show simplistically. So no downside and market linked growth. Then we have the control. Structural control, maintaining control of timing, access, and outcomes. Protected ownership. We set this up in a trust. We set up a trust for you, the client, and we have a overarching director trust that does the borrowing and the leverage. You only have 5 years of funding. You only put money in for 5 years. Very turnkey. From those indexes, what we just showed you, you can just leave this alone. You don't even have to look at it at all. I check with clients once a year before the anniversary because that's when you can change. And after you've put in your 15 years, you have major flexibility, access to cash value, no forced withdrawals, no taxes. And each policy has about 25 riders designed to reinforce this control to protect the structure. There's a lot going on in this area of control to build Kaizen. You don't need to understand it all, but there's a lot going on. I need to show you a little bit about the payments. I mentioned the 5 years. That's representing the silver pigs. 5 years of payments. The bank is approximately putting in about the same amount in that first 5 years. That's the gold pigs. Then after you're done in 5 years, they continue what they were paying, and they also pick up what you were paying. About 3 to 1. So if you're putting in $20,000 a year for 5 years, $100,000, then they're going to be putting in over 10 years about $300,000. This is structured differently in traditional borrowing. There's no personal guarantees required, no outside collateral required, no traditional loan process, institutional underwriting built into the structure. Let's see. This isn't removing risk, it's reallocating and managing it through the structure. Then we have the leverage that we've been talking about. Oh, I put those slides in the wrong order. I'll have to fix that. Using institutional capital, outcome, enhance the outcome. Institutional leverage, 3 to 1. Non-recourse structure, no personal guarantees. Efficient capital use. Keep personal assets working elsewhere. Put more money out other places. Accelerated outcomes. Reach your objectives sooner because of the borrowed money. Yes, it is life insurance, and life insurance has a cost. Unlike traditional investment fees, this cost is not a percentage of assets. It's structurally determined by death benefit, age, and health. I'm going to try to give some samples in the future, but the question is there a cost? The question is, that isn't the question. The question is, does the structure create more value than it consumes? What the structure enables, it enables all these benefits we've been talking about, and the goal is a structure that provides superior outcomes. I'm going to go into a hypothetical example, and it's a good time right after mentioning life insurance costs, but if I'll show you how the structure and results is, you'll see that this Kaizen structure overcomes all the costs of life insurance. Our software that we use is called, we built Interactive Learning Information Systems. It's a website they can have access to, and there's estimate my benefits. See the third bullet point on the left? Well, all these numbers were generated by this software. So here's our hypothetical Kaizen profile. I should put male. Male, age 46, excellent health. He wants to put in $70,000 a year for the 5 years. Then he wants an income starting at 65. And he wants to make sure it's happening through 90. And the illustration current rate that we're using is 6.81. Actually regulated by the National Association of Insurance Commissioners. We're going to use an income tax rate combined of 37 and a capital gains rate of 20%. The reason I use a 46-year-old and 70,000 is this is the average age of everyone who buys Kaizen in the country. And the 70,000 is the average contribution of everyone who's buying Kaizen in the country. So this is the typical buyer of Kaizen. I'm going to show you, we can give you some numbers, a distribution number starting at age 65. We're going to show you a total, how much we paid through age 90. We're going to talk about the death benefits. And I'm going to compare Kaizen with an after-tax investment, meaning 6.81%. I'm going to compare with also a tax-deferred IRA 401k investment. So you can get a feel for if this Kaizen works. So here's the first. An after-tax investment making 6.81 in the taxes would generate $58,642 per year starting at 65. By age 90, they have pulled out $1,524,000. Now, in this illustration, I wanted to show us maximum amount that I want biggest number, that 58,000 possible. So to do that, from 65 to 90, I used every penny. The income at age 91, there isn't any, is 0. I used every penny at 6.81. Then let's look at an IRA, 401k. Tax deferred improves your income. Wow, that's quite a bit more, 74,106, 1,926 through 90. And then we have Kaizen. You're wondering, how much is this Kaizen? Here's a drum roll, please. Is it going to be, well, I guess it's more than 74, 84. What do you think it is? Well, the drum roll, please, is 130,000 approximately. Wow, that's a lot more. We've recovered, we had the life insurance and the living benefits virtually free. We've got income of $3,380,000 through 90. We had a death benefit starting at age 46 of $2,004,000. We had a death benefit at age 90 of $1,702,000. And if we want to continue this income, probably through 100, we could have. It doesn't stop. That's why I like Kaizen. Oh, I forgot to tell you, that's tax-free too. So we've test tested Kaizen against the two worst scenarios we could find in our country. The first was the 1980s. High rate environment, loan rates reached 16.88. We're going to simulate as if we were selling you Kaizen in the 1980s and simulate these high interest rates to see if this Kaizen strategy remains viable under these extreme borrowing costs. Then we're going to do another one. We're going to do a stress test Kaizen against the Great Depression, the 30 through 32, the worst sequence of returns in U.S. history. We're going to do 9 years of zero return over 12 years. Remember, we don't have a negative year, so the worst is at 0, and we're going to show 0 for 9 out of 12 years. The 1980s, it had been 87,500. Oh, still much higher than the 74 or the 58. Wow. And guess what? It didn't tell you. But in the 1980s, those first two had been going down. If it goes down the same amount that Kaizen did, you'd have 43 in the after tax. You'd have 55 in the tax deferred. Wasn't immune, but you're at 97. Even their best, or the 6.81, was 74. Then we got to look at the Great Depression. Well, it's lower than the 97. 9 years of zero is 84. Still higher than the 74 or the 58. And if we did the same downturn on those, it'd been 38 and 48. Pretty immune from downside risk. Wow. In bad times. I got another drum roll, please. What could I possibly be doing here? What I want to show you, I'm going to do a drum roll. See that 130? Well, Allianz, one of our companies we deal with, as we sell life insurance with, they wanted to look at this ILIA illustration system. They wanted to check it out to make sure we were not making mistakes. And they saw that 130, and they wanted to check it out. They discovered that there's an 80% chance, that that 130,000 is going to be double. 80% chance that 130 is going to be double, 260. Now we have the full range. This investment might give you income of 260,000 a year. You'll pull out 6,760,000 through age 90, or on the 6.81 return, 130,000, or in the stress test, 97 or 84. Better than any other option. That's why I like Kaizen. Oh, I want to do one more thing. I forgot. Remember, we've been talking about this guy, excellent health. Well, what if he's just average health? Just average health. The 130 went down to 120. Oh, so even if he has average health, the insurance cost is going to be more, but it still looks very good. And the double looks very good. And the stress testing looked good. So even if it's average health, I did one more. What if it was a female? Ladies, you live longer. 130,000 went to 133. Not a great amount, but a little bit. So there's the excellent health, the average health, the female health, if I should call it that such. Let me show you some history. The very first policy of Kaizen was issued in 2012 to one of the founders. And the anniversary is on June 27th every year. And you get a statement every year on shortly after the anniversary. This is her statement of June 27th, 2025. She is average from day one, 7.85 return. Looks pretty good. She's averaged an interest rate that she's been paying on the borrowed money, 3.95. Well, looks pretty good. And then we can create a spread. We can take the 7.85, subtract the 3.95, and come up with it. She has made 3.9% on the borrowed money. Wow. 7.85 on her money, 3.9 on the borrowed money. Wow. That's what leverage does for you. Now, I want to give you a feel. Long-term historical SP 500 returns are average around 10%. Well, Jim, that 7.85 is lower than 10. Yeah, it is. But remember, that's tax advantaged. You're probably going to be able to pull that out tax-free. Well, okay. So let's take just taxes at 25%. that'd be 7.5. So it really competes nicely with the lower risk. With the inversion protection, it looks great. Most people focus on outcomes. Wise people focus on how the system is structured because results rarely fail from lack of effort. They fail from poor design. Inversion teaches us to ask better questions, not what result do I want, but what structure provides the result consistently. Because success is not an event, it's a system in this area. Structure first, results second. Transformation follows structure. We have some tools for all of you to use. I have 4 ways for you to learn about Kaizen. First, this is a landing page that has videos and an illustration system and chapters on explaining all the details on Kaizen. And there's the QR code that you can go to this landing page. I won't know you're on it, and nobody will know you're on it. We're not just getting your information. So you can spend all the time you want studying Kaizen with this site. We have another one that's basically very similar, but is on the gifting strategy, where you want to gift it to your son or daughter or grandchildren. This is just a little more narrow focus on the reason. Gifting. That's the second way. A third way is this Ilia software that I use to do that. This in here, you need to have a login and a password. I can send you an invitation. I need your name, your cell phone number, your email, and your birthday. Not a lot of information, but that's a little bit, and I can send you invitations so you can set up your own account, log in and password. And the last is my website. My website, I think, is pretty powerful. I've got a lot of quick links to help people out in life. One of the things on my website is I built an income gap calculator. Simple to use. You just put in your numbers and it's going to show you where you are today, like what your gap is on getting ready for retirement. I've got 2 of them. I've got a basic and an advanced. The advanced takes in Social Security and 401ks and everything, but this is really, really simple and easy. Engagement. How would you want to engage with Kaizen and myself? Well, there's those first online versions. Learn at your own pace, digital engagement. When you need help or you have a question, happy to answer. Kaizen Online Advisor backed. Not everyone wants to do it that way. Some want a one-on-one. I'm okay. Happy to take you to lunch, go to dinner, answer questions. Take all the time you want. It's the same strategy, different engagement styles. I understand. The right path fits how you think and how you decide. Service after the purchase. There's me. There's OakTree Strategic Leverage. But then there's the oversight by the founders, the designers of Kaizen NIW companies. They monitor and structure and coordinate all these parties. There's the institutional parties, the life insurance companies. There's the trust company. They handle all this. And even if I'm no longer involved, is that a nice way to say something? These institutions is going to make this very turnkey and easy for you. So my webinars, is there a better way? Here we are in the fourth one down, the bi-monthly. And a month from now, we'll do the business succession. The first three we do every month. Inversion thinking, the basic one that I call it the flagship. Then I do one on retirement. Then I do family gifting. And then these executive and business succession. I haven't built those last three. I'm actually thinking about two other presentations. We'll probably want to build it for those. Oh, well. Anyway, here's my webinars for the coming up. We got April 22nd. This is a screenshot territory that you can take the code, so you can go right to that webinar. Oh, we are April 22nd. I could have taken that off. Well, the 30th, the 30th is going to be the flagship again at 11 a.m. I'll be in Orlando, and then the May 5th we'll be doing one on retirement planning again. I'll still be in Orlando, and on the 12th I'll be home a few days. We're going to talk about the family gifting again. So there's the next three. So Kaizen for key executives, employer contributes for first 5 years. Bank leverage multiplies capital, index growth with floor, 15-year bank exit, long-term accumulation, creditor protection, tax advantage access. What failure does this remove? Market collapse, underfunded risk, tax drag, short-termism, weak vesting. Why carriers change? Why this changes behavior? Executive with a structured wealth, defined timeline, downside protection, growing asset. Think long-term. Long-term thinkers stay. That's retention. Your employees are going to like this. They're going to cover so many of their worries of life. Version summary: most companies design benefits to reward performance. The smart companies design benefits to remove financial failure. And when you remove financial failure, loyalty compounds. Why employers like it? Flexible design, performance alignment, vesting control, talent differentiation, non-dilutive, structured retention. For business owners and advisors, if you want to explore executive retention, wealth transfer, supplemental retirement, this is a structure that works. What clients tell me, no matter who they are buying Kaizen, they like the zero floor, they like the free and the tax-free growth, they like the flexibility that they're going to have down the road, they like the 5 years, and they like the death benefit and the living benefits. These likes none of these are chasing higher returns. They're all about removing the risk, increasing control, creating certainty. So after 35 years in investment advisory business, I've learned to separate products from structures. Most financial tools are products. A few are structural, very few. When someone has the runway, the time, and the health qualifications, I've yet to see a more efficient long-term structure than Kaizen, because when properly designed, it becomes transformative by nature. I hope you've enjoyed being with me today. Is there a better way? That's the flagship webinar. There's those QR codes if again you like. And I'll talk to you, what is that, about a week or so from Orlando if you tune in for the next one. Jim Barlow, OakTree, Strategic Leverage. Have a great day.